Assalamualaikum everyone. Today I will be presenting about executive summary of Malaysia Sdn Bhd. The company was established in 1976 and originally operated under the national brand before switching to global Panasonic name in 2003. Its core business focuses on sales, marketing, and after-sales service for a wide range of consumer electronics. Panasonic Malaysia also shows a strong commitment to sustainability, earning Environmental Management System (ESG) certification since 2004. Looking at the financial performance from 2002, 2020 and 2024. First, return of asset and return of equity fell in 2022 but recovered by 2024. The gross profit margin dropped in 2022 then improved. Inventory and receivable turnover both improved in 2023 and 2024. Liquidity stayed strong throughout the period. Overall, Panasonic Malaysia remains a strong player in the market with ongoing improvements in efficiency and a firm focus on sustainability. Next, we're moving on to company's information. It is a subsidiary of Panasonic Corporation, a global electronics leader from Japan, founded in 1918. In Malaysia, the company is a key player in the consumer electronics industry. Panasonic offers a broad product net range, including home appliance, audio-visual equipment, and automotive systems, meeting both household and commercial needs. The company benefits greatly from Malaysia's strategic location and open economy, which support its operation and distribution network across the region. Panasonic competitive strategy focuses on three main pillars, which is innovation, cost efficiency, and sustainability. This helping the company stay relevant and forward-thinking in a fast-changing market. Thank you. Next, I will pass to the next presenter.
Thank you, Khairon Akmal. Now, I'll present the analysis of profitability ratio for Panasonic Malaysia over the 5-year period from 2020 to 2024. First, let's look at return on equity. In 2020 and 2021, ROE remained strong at 14.33%, reflecting stable profitability relative to shareholders' equity. However, in 2022, it dropped significantly to 6.73%, likely due to operational or external challenges. Fortunately, Panasonic showed recovery in 2023 and 2024, with ROE improving to 10.08% and 11.39% respectively. This suggests the company is regaining its profitability strength. Next, return on asset. ROA was strong in 2020 and 2021 at around 11.98%, indicating effective use of assets to generate income. In 2022, it declined sharply to 5.61%, again signaling challenges in efficiency. By 2024, Panasonic improved to 9.81%, showing better asset utilization, though still not reaching yearly peak performance. Third is gross profit margin. In 2020 and 2021, it stayed above 18%, but dropped drastically to 10.91% in 2022, possibly due to rising production costs or pricing pressure. A gradual recovery happened in 2023 and 2024, reaching 15.38%, though still below earlier levels. Now the operating profit margin. This ratio was quite volatile. In 2021, it fell to a low of 0.66%, reflecting high operating costs. However, in 2023, it jumped to 4.35%, showing strong cost control and operational improvements, before slightly declining to 2.51% in 2024. Lastly, net profit margin. It followed a similar trend. After being above 11% in 2020 and 2021, it dropped to 5.93% in 2022. Encouragingly, it covered to 10.23% in 2024, showing better overall profitability despite prior setbacks. In conclusion, although Panasonic Malaysia faced profitability challenges, especially in 2022, the company has demonstrated resilience and recovery in recent years, driven by better cost management and operational efficiency. I'll pass to the next presenter.
Thank you, Isnana. Now, let's look at Panasonic Malaysia liquidity performance focusing on two key ratios, the current ratio and the asset test ratio. For current ratio, Panasonic Malaysia started with a strong current ratio of 4.55, meaning the company had more than enough current asset to cover its short-term liabilities. In 2020, the ratio remained of 4.55, showing stable liquidity, and then slightly decreased to 4.38 and continued to 4.21, indicating mild financial pressure likely from higher liabilities or lower current asset. However, in the latest year, the ratio jumped to 5.18, showing a strong recovery likely due to improved financial management and a better balance between asset and liabilities. The second is asset test ratio. The asset test ratio, which excludes inventory, also began at 4.55, reflecting a strong ability to match short-term obligation with the most liquid asset. It dropped to 4.38 and then to 4.09, showing a slight decline in liquidity, possibly due to lower cash of receivable. The ratio then improved to 4.75, maintaining a healthy position and remained stable, showing that Panasonic managed its liquid asset effectively. Let's move to financing ratio for Panasonic Malaysia, which show how the company managed its debt and capital structure. For debt ratio, over the past 5 years, Panasonic Malaysia maintained a debt ratio well below 1.0, range from 16% to 14%. This low level of debt showed the company relies very little on external borrowing, which strengthened its financial stability. The drop to 14% in 2023 signal improved debt management and a lower financial risk, a positive indicator of long-term sustainability. For debt-to-equity ratio, from 2020 to 2022, the debt-to-equity ratio held steady at 0.2, then dropped to 0.16 in 2023 to 2024. This consistently low ratio reflects a balanced approach to financing with limited dependence on debt. The decrease in 2023 indicates greater financial prudence, reducing leverage and boosting both financial strength and investor confidence. Conclusion: overall, Panasonic Malaysia low and improving financial ratio demonstrates strong financial discipline, low risk, and solid investor appeal. Now, I will pass to the next presenter. Thank you.
Thank you, Sister Inshara, and hi, my name is Amrin Mirzal, and I'll be presenting about the activity ratio of Panasonic Berhad. So we have prepared a graph based on our calculation of activity ratio for Panasonic Berhad. So this graph consists of inventory turnover, average age of inventory, account receivable turnover, average collection period, account payable turnover, average payment period, and total asset turnover. And this graph shows the overall trend of all activity ratios from 2020 to 2024. So as we can see, there's a drop around 2021 and 2022, meaning the company was less efficient during those years. But from 2023 onwards, most ratios started to improve, inventory moved faster, collection got quicker, and assets were used more efficiently. So overall, the company is becoming more efficient and managing its operations better now. So now that we have seen the overall trend of Panasonic Berhad, so let's take a closer look at each ratio one by one. So now we move on to the explanation for each ratio in the activity ratio. The first one is inventory turnover. In 2020, inventory turned over 13.88 times until it dropped at 2022 but improved to 10.94 in 2023 and 12.55 in 2024. This shows better inventory movement in recent years. So we move on to average age of inventory. The average days inventory state increased from 27 days in 2020 to 38 days in 2022. It then improved to 30 days by 2024, showing better stock control. So, and then account receivable turnover. So receivable turnover was highest at 2020 at 11.68 times. It dipped in 2021 until 2022 but recovered slightly to 10.06 in 2023 and 9.75 in 2024, showing a steady collection. So we move on to average collection period. The collection period peaked at 44 days in 2020 but improved to 37 days in 2023. This means that the company is collecting payment faster. Next, accounts payable turnover. Payable turnover declined slightly from 5.69 in 2020 to 5.55 in 2021, suggesting quicker payments to suppliers. Next, average payment period. Payment period reduced from 65 days in 2020 to 59 days in 2024, indicating faster payments and possibly better supplier terms. Total asset turnover. Asset turnover dropped to 0.92 in 2022 but rose to 1.08 in 2023, showing better use of asset to generate revenue. So, in summary, activity ratios shows improved efficiency in inventory, receivables, payables, and asset usage. The company is managing its operation more efficiently overall. So that is all for me, and I pass it to the next presenter, Sister Sarah. Thank you.
Thank you, Amrin Minsal. I'll be wrapping up our presentation by briefly highlighting Panasonic Malaysia's market performance and key recommendation for the future. Panasonic earning per share peaked in 2022 at RM8.50 but normalized to RM1.53 by 2024. The price to earning ratio also fluctuated by showing signs of inconsistent investor confidence. Meanwhile, the market to book ratio dropped to 1.35 in 2024, suggesting that the market is valuing the company more consciously despite its financial recovery. Next, we're moving on to the key recommendations. Firstly, to improve inventory management, where to focus on faster moving products and consider just-in-time system to reduce holding costs. Secondly, company can control operating costs, where can tighten financial planning to improve profit margins and cash flow. Thirdly, to invest in innovation, where continue R&D to launch smart and sustainable products that meet the market demand. In short, Panasonic has strong fundamentals but need to focus on efficiency, innovation, and cost control to strengthen its market position going forward. That's all from us. Thank you.